But what exactly is insurance? What is the meaning of it? How does the insurance operate? Insurance is defined as a cooperative device to spread the loss. The functional definition of insurance, it's very important to understand what is the functionality. You are trying to draw a contract between you and the insurance company in terms of any loss. Good morning and welcome to the first session of Unit 4 in Management of Banking and Insurance Services. And here we are going to speak about a very important topic called as the insurance. Now, the concept of insurance is not very new to us. It's a very old business, and this has been something that has been carried forward in our day-to-day life. But what exactly is insurance? What is the meaning of it? How does the insurance operate? Let's have a quick look through this session. Moving forward, insurance is defined as a cooperative device to spread the loss caused by a particular risk over a number of persons who are exposed to it, who agree to insure themselves against the risk. Now, the general concept of insurance itself is based on the risk factors. We take insurance for the unknown risk that can come in our life. Now, all of us know that insurance is something that's subject to matter of solicitation, which means to say that insurance can be acknowledged and understood only at the time of emergency. It's not a regular investment tool kind of thing where you would see a returns coming from it. So whenever you feel that there is some risk that is involved in your life, it might be about your day-to-day life, it might be about your property, or it might be against any of the natural calamity, you want to take a backup. You want to be sure that at any given point of time, there is somebody who can back me up, who can help me out during the time of emergency so that I can cover myself, I can cover my family, and I can be rest assured about it. So that's why the concept of insurance is highly regarded in terms of the financial services business. And most of the banking services are today linked with insurance. When you talk about banking services itself, all the bankers are tied up with one or the other insurance services of their own, or they are tied up with any other private agency through which they provide insurance services to their customers. Now, moving forward, the functional definition of insurance, it's very important to understand what is the functionality of an insurance. Insurance, as we have said, is a cooperative device. Apart from that, insurance is allowed to understand the spread of the risk, and this is actually used to cover the people who are insured. So the principle behind insurance is that to share the loss of each member of the society based on the probability of their loss to the risk and the method which it's provide. So simply, if I have to say that insurance is distribution of loss falling on an individual or on a family or on a large number of people in the society. Now, if you look into a very simple aspect called as motor insurance, for an example, how many times while riding on the road you are prone to accident? Now, God forbidden that does not happen anytime in your life. But then if I have to do a probability ratio to understand how many times you can get hit by a vehicle, the probability might be 1 in 100 or 1 in 1,000. But then what does the insurance company look into is that when that one incident happens, then that is going to be a loss to the life as well as to limb. There is going to be a loss to the property as well as to the owner of the property. So by keeping that probability that a loss might happen, and when that loss needs to be covered, we need an insurance factor behind it. We need somebody who can go forward and take care of the entire insurance cover or the entire insurance matter. So in that sense, I would always say that insurance is one of the very important factor. Insurance is one of the most demanding or a pressing need of the state, of the need altogether. Why? Because without insurance, we will not be able to proceed further or do anything as per the plan. So I would always say that insurance is something that we need to look at it in a very clever manner, in a very in the way how it has to be designed, in the way how it has to be looked into. It's a very, very important factor. And every single member in this society should have some or the insurance that tries to cover his life, that tries to cover his properties, his assets in the long run. Moving forward, let's try to understand the contractual definition of insurance. First of all, is insurance a contract? The answer is yes, because you are trying to draw a contract between you and the insurance company in terms of any loss. So as per the definition, insurance has been defined to be a sum of money which is being paid as a premium in consideration of the risk occurring, paying back a larger sum upon the contingency, whereby the contract says that certain sum called premium is charged in consideration. So every year I pay certain amount of money as premium to the insurance agency. Why am I paying this insurance agency the premium? The reason is that in the long term, I should be covered against any loss or any contingency factor. So when you look into here, it is a contractual agreement. The insurance company says that you will be protected against any kind of contingencies or emergency, provided you are paying a premium to cover yourself. So my premium is going to be my root cause for the coverage in the long run. So that is how you need to understand the concept of insurance from a contractual standpoint. Now, when you start looking here, it also says that a large sum is guaranteed to be paid by the insurer who received the premium. So now the insurer comes back and says to you that yes, in case of any emergency, you will be paid back as per the terms and conditions, whatever amount as a coverage value back to you. Now, the payment will be made in certain definite sum, the loss or the policy amount as it has been judged, and the payment is made only upon the contingency. Now, this is the most important factor. As I have told you in the beginning itself, insurance is only made on the basis of contingency or on the emergency time period. Insurance will not be made on a regular basis. This is not a money that you can take it on a daily basis, a monthly basis, or weekly basis. Insurance is something that is only a matter of subject. So when a situation happens, at that point of time, you claim insurance. You cannot go to the company and say that, sir, every year I'm paying premium, so you need to return back my money. It is not accepted. Insurance will be given only when certain things happen to you. So what happens? By God's forbidden, nothing happens to you. If you are not getting affected by any kind of factor, at the end of the particular time period, you get back as a lump sum bonus from the insurer. But in case if something happens to you or to your family, the insurance company promises to pay back the money at a certain rate of interest, at a certain amount altogether, and for whatever your policy cover is worthwhile. Followed by, it is also defined as consisting the one party called as the insurer and the other party which is going to come about the company altogether. Now, there might be beneficiary clause also coming here in terms of understanding the insurance. Now, for example, if something happens to you, the money might go immediately to your wife, to your mother, or to your father, brother, or sister who are called as beneficiary or nominee in the case of insurance. So what happens here is that if you are the person who is affected by a grave tragic incidents altogether, that money shall be paid back to your members of the family upon that contingency or emergency happening altogether. Moving forward, the features of the insurance. What are the features of the insurance? The features of the insurance is sharing of risk. Now, that is a very, very important factor that you need to understand. Now, the insurance is a device to share the financial losses which might befall on an individual or on his family on happening of a specified event altogether. So now, when you start looking into the features, the first thing itself is sharing of the risk. The insurance company shares the risk with you in case of any emergency or untoward incident. So that's where we share both mutually. So that doesn't mean that I will alone cover you for 100%. we share equally on behalf of the emergency or contingency factor. The event may be a death of a breadwinner of the family in case of life insurance, marine perils in case of marine insurance, fire insurance in case of fire, or a motor insurance, all this factor. So everywhere you see that there is a specified insurance which is being used to cover the entire incident, to cover the entire factor altogether. So that's why this comes into picture. Moving forward, we are also going to talk about the word called as cooperative device. Why do we call this as cooperative devices? That because a large number of operations and the factor is primarily dependent upon the ideology that people cooperate. There are a lot of people who are linked with this insurance factor. And when the financial loss or anything happens, it is a mutual understanding between the insurance company and the insurer that yes, he would be paid back depending on the kind of factors that has happened. Second thing is that the large number of people are bought together voluntarily or to publicity or the solicitation of the agent. So insurance cannot work as a in solo in terms of a separate island kind of a phenomenon. It works in cooperation with people, with agents who try to join hands together, who market, who go and tell people what is the value of insurance and why you need to take an insurance. Followed by the value of the risk. Now, what kind of risk are we taking altogether? So, the risk is evaluated before insuring the charge of the amount, and the share of the insured therein considered upon the entire value of how it is being done in terms of the premium factor. So, based on the risk, the premium shall be decided. In simple words, suppose the risk involved in the nature of business that you are doing is very high, the premium charged will also be high. Suppose the nature of the business or the operation is lesser, the premium will also be lesser. Why is that this is coming into picture is that there are several methods to evaluate a risk. Based on the evaluation of the risk alone, the premium can be fit. If the expectation of more loss, then automatically a higher premium will be charged, which means to say that the probability of loss is calculated at the time of insurance. This is a very, very important statement which I would like to say. Probability of loss is calculated at the time of insurance. So what is the chances that your business can go for a default? What is the chances that there might be an emergency arising? What is the chances that there might be an exigency situation created? So based on that probability, we will calculate the value of insurance. Moving forward, we are now going to talk about the payment at contingency here. In the payment at contingency, we try to understand that the payment is made so that that particular event is already insured. It is not done because it will come and then I will make a payment at that point of time. It is being taken care, and that's why we keep paying that premium. If the contingency occurs, then the payment is made from the company towards the insurer. Since the life insurance contract, we would like to understand here that in case if something happens to the life of the human being or to that person, at the expiry, for example, if the person passes away or anything untoward happens, then the money shall be given to the beneficiaries or to the members of the family. In case if nothing happens to it, he completes the term policy of that insurance, and then automatically the money is returned back to his family members. Moving forward, the payment of fortuitous loss, what I would like to talk about. This payment of fortuitous loss is another important characteristics which I would like to talk about. This is an unforeseen or an unexpected that occurs as a result of chance. Yes, there is some chance factor which we have to understand in business. You might have not thought about it, or you might have not simply worried about it. All of a sudden, there is some mistake, there is some chances where something happens altogether and you have nothing to blame at that point of time. So what happens here is that that loss will be considered as an accidental loss altogether. So when some default or some kind of incidents happen in your life which you are not in control, which happens by a chance, which happens by an accident, yes, that at that point of time the losses will be covered by the insurance. The law of large numbers is based on the assumption that losses are accidental and they occur randomly. Now let us understand the theory of probability in insurance very keenly. Why? Because many a times the insurance companies try to understand the probability factor of one event occurring many times in a particular case or in a particular sector altogether. So when we talk about a motor insurance, or when we talk about fire or marine insurance, or about the home insurance and all those factors, there are a lot of chances or probability that the insurance company will look in where these kind of accidental charges or accidental factors might happen, but what is the level at which it can happen? So that's why they take a large sample to understand what are all the accidental losses or accidental factors that can ever happen in that scenario. Amount of payment. So how much amount are you paying back in terms of insurance? So the amount of payment depends upon the value of loss that is occurred due to the particular insured risk provided, and there set up upon the amount. In life insurance, the purpose is not to make a good financial loss suffer. The insurer promises to pay fixed sum on the happening of an event. So this is where it is very important. So the insurer says that once that event happens, once that particular contingency happens, then we go forward and we take this particular insurance altogether. If not, then we are not switching over for this kind of insurance altogether. So we don't want to go further in terms of thinking about the insurance at any point of time unless and until this insurance is going to happen. So what I would definitely like to say is that compared to the risk factors, compared to the challenges that are happening, we need to understand that in life insurance, the most important purpose is that we don't incur into the financial loss, but in case, suppose if there is a financial loss happening, then the insurer takes charge of it and he makes the payment on time. If the event or contingency takes place and the payment does fail, if due the policy is valid or forced in that event, like the property insurance, the dependents will not be required to prove the occurring of loss or the amount of loss. So in this case, suppose if the policy is still in active force, the policy is very much alive, and if something happens there, then you don't have to worry. Automatically, since you are covered under that particular incident or that particular act, you don't have to worry, you will be paid back altogether. There are times when you need to understand that in insurance, only certain factors are covered and other incidentals or accidental charges are not being covered. So what is very important for a person is that he starts looking in for a comprehensive policy which can look forward into all kind of factors and then make the complete coverage for that individual. Now, a large number of insured persons to understand this, to spread this loss immediately and smoothly. So what we do is that the insurance companies tries to spread the risk among large number of people. That's why most of the insurance company will have large number of people working, insured, so that what happens is that the risk is completely divided among them. The cost of insurance for each member might be high, but it is unmarketable. Why? Because many of time the insurance has to become cheaper, means it has to become divided by so many number of people, and then the insurance premium will automatically come down. With this, I come to the conclusion of this session. I hope and believe that this session was highly useful, interesting, and informative in nature. In the upcoming sessions, we will be talking more about the insurance services and business in various factors. Until then, goodbye and stay tuned, stay blessed. Thank you once again for joining me on this wonderful session.